Ever wondered how fluctuations in currency exchange rates can dramatically affect your international investments? It's a fascinating world where the ebb and flow of economies, political landscapes, and market psychology interweave to create a complex dance. This dance, in turn, influences the value of one currency against another, thus directly impacting your returns. It's a subtle game of balance and foresight where knowledge is power. Understanding the fundamentals of currency exchange rates is vital for any investor venturing into the international market. Currency exchange rates, simply put, are the rates at which one currency can be exchanged for another. Imagine a marketplace where instead of buying and selling apples and oranges, we're dealing with dollars, euros, yen, or pounds. In this market, just like any other, the price of these goods, in this case currencies, fluctuates based on supply and demand. Let's break it down a bit further. Several factors can influence these rates. One major factor is economic performance. When a country's economy is strong, its currency becomes more attractive because investors expect higher returns from that economy. On the other hand, a weak economy can lead to a decrease in the demand for its currency, which will subsequently lower its exchange rate. Another influential factor is inflation. If a country has a lower inflation rate than others, its currency will generally strengthen compared to other currencies. Why? Because lower inflation rate means increased purchasing power, and who doesn't want more bang for their buck? Political stability also plays a significant role. A country with less political risk is more likely to attract foreign capital, leading to a rise in exchange rates. Remember, these rates are in constant flux, changing every second of every day, influenced by these and other factors. Now, you might be wondering, how does all this relate to my international investments? Well, let's delve deeper. When investing internationally, you're not just betting on the performance of a company or sector, but also on the performance of a country's currency. Now, let's dive deeper into how fluctuations in currency exchange rates can impact the value of international investments. Picture this. You're an investor from the United Kingdom and you've decided to invest in a promising tech startup based in the United States. To make this investment, you convert your pounds into dollars at the current exchange rate. Now, let's say the dollar strengthens against the pound during the time you hold this investment. What does this mean for you? Well, it means that if you were to sell your shares and convert the dollars back into pounds, you'd get more pounds than you initially put in. This is because each dollar now translates into more pounds than before. Conversely, let's consider a situation where the dollar weakens against the pound. In this case, when you sell your shares and convert the dollars back into pounds, you'd receive fewer pounds than you initially invested. This is because each dollar now translates into fewer pounds. So you see, the value of your investment in pound terms can increase or decrease purely due to changes in the currency exchange rate, independent of the actual performance of the company you've invested in. Now, let's take this a step further. Imagine that you're a global investor with a diversified portfolio that includes investments in various countries. Fluctuations in currency exchange rates can impact the overall value of your portfolio. If the currencies of the countries where you've invested strengthen against your home currency, the value of your portfolio in home currency terms increases, and vice versa. Therefore, navigating the world of international investing isn't just about understanding businesses and sectors, it's also about keeping an eye on global economic indicators and currency exchange rates. Thus, a keen eye on currency exchange rates becomes an essential part of international investing. To sum it up, currency exchange rates are a crucial factor in international investments. They are the lifeblood of the global economy, dictating the value of money from one country to another. These rates are influenced by a myriad of factors, including economic indicators, geopolitical events, and market sentiment. When it comes to international investments, these rates play a significant role. They can either amplify your returns or erode your investment value. A favorable currency exchange rate can increase the value of your overseas investment when converted back into your home currency. On the flip side, an unfavorable rate can eat into your profits. So it's not just about picking the right investment, but also about understanding the nuances of currency exchange rates. As you step into the realm of international investing, remember to keep an eye on these rates, for they can be the difference between profit and loss.